coming out here on a Wednesday. How's everybody feeling about this space? Isn't it pretty amazing? Big props to the BBB for having such an incredible space. Who would have known? Now you know, poster events here. I'm very excited about today's conversation because I am looking to the future personally. I'm looking at what is my path to VC. I am building my portfolio as we speak and trying to learn, get up to speed, get prepared. And so today's conversation is really going to be all about taking that journey and what it means to go ahead and take that journey, the risks, the opportunities, the excitement, the game of it all. We're very, very lucky to have a wonderful speaker here, Teri Kelly with Morgan Stanley. She has a wealth of experience that she's going to bring. She's been here, done that, which is really cool. We always love to have a Jane here with that level of experience who can help us and help lead the way. And we're going to go through a handful of questions that we have, just things that came to mind with when Ali and I were talking about why having this conversation would be so impactful. And then there's going to be lots of time at the end for you to ask questions. This is first and foremost a community. This is first and foremost a space for all of us to be workshopping our paths into VC together. So if you have a question, don't be shy. This is a kind of raw, exciting, and we'll say unfiltered conversation that is meant to prepare everybody to take these steps. So I'm actually going to back up a couple slides before we dive in, because we always like to start with our purpose. We're here to get more women on the venture capital playing field. Because what we know is that when women build wealth and influence capital, we all benefit. When women hold wealth and invest in companies, more problems get solved and our community is stronger. And that is the root of what brought us to the table for the Jane Project. Now, as we get going, I want to give Teri some space to tell us about your background. What led you to being a financial advisor? I was hearing little bits of your story earlier, and so I want to hear more of what led you from there to here, and also what keeps you here. What is rewarding to you about being in this space?
Gosh, how did I get in this space? I grew up with parents. I'm going to go way back, way back for a hot second. I grew up with parents who were school teachers, and my dad was a science teacher who was really interested in investing. And so it just sounds, I mean, it's not your standard conversation, right? I don't have a finance degree. I mean, I didn't come here intentionally. But what I would say is when I was in college and after college, he would send me articles from the newspaper. Remember, there were things that you used to get in the mail called the newspaper. He would cut out articles and mail them to me and talk to me about compounding interest and portfolio growth. And the one that really stood out in college was, he sent me this chart. It was like, if you save $2,000 a year in your 20s and you never save again, you'll have $1 million when you're 65. And I was like, what? Like, I think I could do that. So I started in my first career, and ironically, Nicole Rose is here, and she and I worked together at the Marts agency in advertising and public relations, because that was my first career. 20, almost 30, I'm not kidding, some years ago. And she's like, don't do that. Yeah, right. And it wasn't fulfilling. Like, I felt like I wasn't giving. It just wasn't my passion. And I was always a marketer, because that's what I studied, but always just interested in saving for me, and then in my I went into a marketing career for about 5 years at a company. And I found out I was 26, 27 when something changed about the retirement plan, whatever. And I was asking my friends at the company, I'm like, oh, what do you guys think about this change? And they're like, what? To what? No one was saving. And I was like, oh my gosh, like, how are we going to travel together later? Like, where are we going to do all the things we want to do if you're not saving? Because we're in this journey together. Like, we're in this together. And I realized that nobody was doing anything, and there's no education. And I got lucky. Hey, Kathy, I got lucky that I did grow up with that education, and I realized that wasn't normal. And it kind of like this, we're not educated a lot about this type of investing. We don't, it's just not a thing. So anyway, fast forward, I've been here for almost 25 years now, working in the investment space, and private investments are a big piece of what we do. And, VC and angel is not something that Morgan Stanley does, but I'm very, have lots of clients who do this stuff on the side. And I'm just excited that there's a group of women and friends here in the room, Janes and Janettes.
If I had $1 for every time I heard a story like that, where especially women in their 20s when they're early in their career, and you survey your friends, and it is startling, the lack of education
Or just the differences, the spectrum is.
yeah. If I had $1 for every time I heard that story, I'd have at least $10, which is not enough to invest and is a segue into the rest of our conversation. But I think it's important. I mean, that is what we're here to do, is to talk about that. When the women here today represent all sorts of different stages in your journey towards venture capital, right? And so the more that we can be talking about it, having these conversations, this is my subtle plug for you to go home and into your offices, into your community, and to talk about the Jane Project and what we're doing here. Maybe not so subtle. That is how we drive change. So without further ado, let's dive in. Quick, early, high-level question. From your perspective, what makes up a healthy, well-balanced portfolio?
If you start in your 20s, which not everyone did, so that's okay. Just the building of the base of retirement plus liquidity. And, my own story, I did a great job of saving in retirement. And then I wasn't saving outside of retirement. And then when I went to buy my first house, I didn't have money. And it's like learning how to understand liquidity versus non-liquidity, and building a base. And I'd say the first part of it is, one, getting comfortable with what is the stock, what is a bond, what is an investment, what is the risk level. Understanding that cash is liquid, it doesn't earn you much, but it's there. It's not going anywhere. And then, the next level is bonds or fixed income. It's super boring, pays you interest, and doesn't usually change that much in its actual principal value. But it's never going to grow at 12%. It's going to, do 3, 4, 5%. It's going to be boring, but consistent. And then you take it up to, stocks, and like you when you own companies, public companies, this is public companies, stocks go up and down. They're generally fairly predictable. Companies have earnings. It's public, like lots of data. The market is liquid. If you want to get in and out, you can sell within the same day. That's the next tier. And then above that, it's private placements or private investments. Not liquid, can't get out, don't always know if the company's doing well. It's like, how comfortable are you up here? So building these baselines is important to have first. And then once you're like, okay, I get all this and it feels good, maybe it's time for me to go to venture into a place that I haven't been before. And having an understanding that you're not going to have liquidity. There's a chance that this thing may not work out at all, and actually a high chance. Are you okay with that? What are you doing it for? Do you have is it purpose driven? What is your intention with it all, to kind of guide what that private piece of it looks like?
And I think that education on those layers is so key. We recently put a lot of our savings into that middle tier you were talking about, that public market. And it is still liquid, but what a scary moment, because it is less liquid, and it feels far less liquid than it being in a high yield savings account, for example. But the opportunities feel strong, right? So
You can also see the valuation of it every day.
yes,
And that's good and bad.
it is. I risk test to that as well.
Yeah.
Is this like kind of questionable for your mental health to watch it?
And we shouldn't watch it every day.
No, I shouldn't. And I have been told not to.
But just learn it. But when you're learning about it, you're drawn to it. You want it. It's good to understand volatility and understanding that. And you really can't understand that if you're not looking at it every day.
And what's been interesting is also the intersection of how the broader world, and we were talking about this earlier, we'll get into this more, but how the broader world and what's happening in the world impacts your portfolio, right?
Mhm.
So, okay, so now, as we're thinking about getting into that tier, that VC tier, that's this exciting new frontier of exploration, we know there are thresholds for being an accredited investor. Real quick, who here knows and can tell me what the requirements of being an accredited investor are?
I'll take a stab at
All
it.
right.
I think you need to have a net worth of $1 million excluding your primary home, or making more than $250 a year for the last 2 years. Just say.
Yeah, so for an individual 200, for a married couple 300,000.
Okay. And it is it's and, not or, isn't it?
I believed it to be
Is it or?
It's or.
Okay.
okay, but I will always take a fact check.
Right.
So okay, so now that we've got that level set, just because you can doesn't necessarily mean you should. So what is that threshold? What is that trigger, so to speak, that says, okay, now is a smart time or at least a rational time for me to start looking at expanding my portfolio into VC?
Um, everybody's different, and there will be people that are never right for VC because they don't like the risk, they don't like the unknown. I mean, we talked about the, cash, bonds, stocks. Like the thing about the stock market is, what it's worth every single day, and you get into private and you don't know what it's worth at all. You may never know what it's worth again. And you have to be okay with that and with the reality of liquidity. If you need liquidity, this is not your bucket. This is your other bucket. And we talked about this before. You almost have to go into it saying, I'm going to go into this expecting that I'm not going to get my money back. I mean, whoever does that, which goes to the women and men. I mean, men tend to jump from the bridge while the woman evaluates it. I mean, it's really like, let's stop being afraid is what I would say. And it's okay. But it's a I think it becomes a dollar figure issue. Like if you say, hey, I've got this stuff set aside, my plan looks good, I'm heading towards all the things I want to accomplish. I'm going to test this out, because what usually gets people over into this space is because they want to invest in a person, a project, a community, something. Like they're interested in something within their community, and I try. I can't come away with some other way to frame it, because I keep saying it's like funding a nonprofit. I mean, it's not. You hope that it's not, but you're funding a company that probably doesn't have revenue or doesn't have a P&L that, I mean, especially on the angel or early venture side, that it's the hope for. You're funding the startup part of something that could be big, and you have to think about it. I also would say going in and doing one is not the right thing either, because that one may not work out, and then you might be scared from it forever. I mean, if you go in and say, well, my intent is to build out 5, I want to have 5 pieces of something venture, and I want they should be in different sectors. You shouldn't put the money to work at the same time for all 5. They should be diversified from a timeline perspective. I mean, you have to go in and say, well, I'm gonna expect that maybe one of these works out. And if you only do one, that could be the one one may not work out. So just like, you need to have that perspective on it. I think a nice way to start is to do it through a fund. And I say that, but they're hard to find. And a lot of times the numbers are big, and they may be bigger than you want to spend, or bigger than an entry point feels like. I actually think that's what keeps people out of it too, is, 25,000 is the minimum. Well, I really need to do 5 of these. Well, it's 125,000. Is that too much relative to am I really willing to risk 125,000? I mean, it depends on your net worth and your situation as to if you get comfortable with that. So it's a build. And if you can find a fund, like Golden Seeds this is how I kind of got started in doing some. You're laughing and doing.
I'm with Golden Seeds.
Are you? Yeah. Okay, great. Well, I'm going to pitch you right now. But I started with Golden Seeds. Well, I had done some one-off things. I was my own personal story, just some one-off things, and never with any real strategy. Just kind of like, and just because I'd never been in it before, and I want to try these things out, and that feels a little scary. I'll be really honest about that. But with Golden Seeds, you're buying a pool, and it's all women owners, women founders. I mean, you have to have, there are all these rules around the companies that get funded. But what I don't like about it's Arizona based as we would like it to be, hence why we're here. But it was a trial for me, and I had a 5-year commitment. I made a contribution every year and I call it that. Like, if this is a contribution, I almost look at it as I'm giving to these women-based companies, and it feels like a give. I'm giving to them because I believe in what they're doing. And so far, and this has probably been 6 or 7 years, say 8 years since one of them, I don't mean to say, actually paid back. Like, we had a $90,000 distribution on a $125,000 investment that I made over the course of 5 years so that was so exciting to see. And that's only one. And there are some companies that are gone in the portfolio, and there are some that are growing that have good valuations. But it's been interesting to learn about it by looking at it through the lens of a fund. But that's not available all the time. And what if 125,000 is too big of a number for how you want to get started in it? So how do you get started? So that's the open question.
Well, and I think that
was a long answer.
Oh, no, that's a good. The more you can share stories about your own experiences, I think the more we get to see ourselves in your journey. And I will say that finding and accessing those funds is a big topic we're having here at the Jane Project. How do we take this community and create channels for women to write smaller, less intimidating checks that allow us to play and experiment? So
and to learn it.
Exactly.
It's learning it and getting comfortable in the space.
And that's actually my next question for you. So you said when you first got started, there wasn't a ton of strategy to it.
Yeah.
So what has the evolution been in your strategy? And, what does that, how do you balance, I want to give into this issue, right? With, I also want to experience the high of getting a return on my investment.
Mm-hmm. The people that I know who play in this space either are really passionate about what it is they're investing in. They know someone who's running something and they want to support them. It tends to be pretty focused. I mean, that's usually or they've got a buddy, who is starting this thing. It's very rare that they're like, and I know it's going to multiply. I mean, it seems to be more like a passion. Like, there's someone and I'm seeing the work that they're doing and I really want to support that. So it's really
the motivation.
I forgot the actual question.
Oh, no, you're good. The motivation needs to be there so that you can kind of stick it through this investment that's not necessarily going to turn around. We'll see, right? When you got started, have you moved or shifted your strategy from, well, I saw this, or, this was interesting, or I knew somebody, to now I'm intentionally going after different things?
Yeah, it's usually something that lands on me. Like, I'm invested in something in Flagstaff, and I have a place in Flagstaff, and I love that community, and I want to support anything. And I don't mean to say anything, but like, my husband and I talked about it, and we're like, yeah, let's do this, and I don't know what the other side of it looks like. And this was like a $10,000 thing. I don't know what the other side of that looks like. I don't know if it's 5 years, if this organization ends up selling and there's a liquidity event. If I got my money back, I would feel like I invested in it and I was a part of it. It's usually things that just come my way,
Fulfilling,
that feel personally fulfilling. And I don't want you all to walk away from this going, well, geez, that feels really charitable. I mean, but you have to have a bunch of them and one will pop and it will be 20 times what you put in. That's how it works.
Are you taking questions now?
Sure.
go for it.
Sorry, you interrupt the flow. I just was curious. So, in your experience, just from a guidance standpoint, do you have any advice for? Hey, oh, thank you, Alex. Do you have any advice for, besides just giving because you feel passionate about it, but how you might decipher what might be a wise investment and what not, and what are some key things to look at?
That's one of your questions. So perfect. No, it's great. Love it. It's great when you come up with questions that people ask. It's awesome. It wasn't even planted. Knowing who you're investing alongside, I think matters. The founder should be in it. And if there's a group of people, it also feels better if you're evaluating something with not just by yourself. Like if you're in healthcare and it's a healthcare opportunity, sometimes you feel like you have a lens into it because of some connectivity to it, but don't be afraid to ask someone that you know who is closer to maybe the sector or whatever, to what do you think about that? I think it's really hard to evaluate startups because the numbers are pro forma.
I know it might be a good time to talk about the difference between direct angel investing and fund investing. So, to your point, if you're really passionate about healthcare, investing in a healthcare focused fund removes the responsibility of doing the due diligence and finding the opportunities, and your money can go further. So, there is a distinction. Yeah. Do you want to, you'd agree with that? Probably.
Yes, I agree. I don't have a lot to say in that area, but I agree. And it may be that you want to pick a sector. If you have an interest area, pick a sector. And, this is, I think, one of the great ways why a community like this can help each other. It's like, who do you know that you feel like can look at something, and how does it, I mean, I've worked in numbers all day, and I still feel like when I look at a, pro forma for a startup, it's numbers.
Yeah. Well, and I think one of the things we were talking about earlier is also about understanding the people behind it.
Yes.
Right. And believing in the team and the people, and that intersection of this is something I care about. I have reason to believe this team can actually do what they're saying they're going to do.
Yeah. So let me tell a current story. I have a client up in Seattle who is in a startup right now after having a big successful thing. He's just in a startup now, and the people that he's been able to bring in are like blow your mind, and that's it. I'm in. And I can't. He's a client, so I can't invest in his thing. But I have full confidence because of the people who have left jobs to come work alongside him are people that would never have left where they were, knowing where they were, to come in to do something. So the people that, or the look at who's on the board. They better have a board, first of all, or they're a group of whatever. Who are the people that are surrounding them and the driving of their strategy? And it's about you're investing in people, really.
Yeah. And I've had this burning question in my head for the last few minutes. And I'm very excited that we have both genders represented, all genders represented here in this room. Do you see, when you're working with clients, where portfolio decision making is maybe more male driven versus female driven? Are they leaning more towards teams and industry data versus I'm passionate about this? Or are we all sort of just jumbling these decisions together and sort of weighing the intersection of them?
I mean, historically, men tend to be the ones that get in the weeds on investments before the women. Women tend to run the cash flow budgeting piece better. I'm just going to say it better. And men tend to be less, I don't mean to say afraid, but less fearful about jumping into some investment. Again, I think that's why we're here, because women are more skeptical over the long haul. All the data says it. Even in public markets, women make better investment decisions because they stick it out. They don't get wishy-washy about buying and selling and buying and selling. I think should we trade this? It's like, no, calm down. You're in it for the long haul. And women who self-manage their investments versus men who self-manage, women have better returns. And that's just data. You can find that data out there everywhere. But yeah, and even when it comes to asset allocation, women are more conservative in general than men. Men tend to have higher risk portfolios than women, which again is another reason why women, I think, are less likely to maybe jump in on VC or private investments.
Absolutely. Is there an industry guideline for a percentage of portfolio that should go into private versus public equities?
The general industry is 10%. And this is a general guideline kind of across some different areas, like 10% concentration in one thing. So if you have if you're work for a public company and all of a sudden the company stock has grown a lot and it's now 40% of your portfolio, whoa, 10% of any one thing is kind of the general consensus. When it comes to, when you look at endowments and foundations that go on forever and ever that have a perpetuity, you tend to see like a 20 or 30% allocation to private and venture and some of these types of areas. But then that's to all of their private placements. So within the private placements, venture's a sleeve of that. But for individuals who don't have perpetuity, I would generally say 10% is kind of on the high end. So the problem is that leads you in a lot of cases to lower minimums. Like if you say, well, I want to make sure I have 5 and 10% is my cap of my liquid investing or of my, not my home, but my investments. Can you hit minimums, especially when you're new to this? Like this is the rub, like how do I get in? It's not a lot of people that'll take $5,000. They want 25 or 50. So now the numbers get bigger. So again, it goes back to if you can get into a fund as a learning process, it's a great way to learn it. But I would say kind of 10%.
Yeah, but that it can,
We talked about this too. If you also don't want to put it all in at once unless it's a fund. The fund typically has its own diversification within it. But if you're building something out, you're not going to put all 10% in at one time anyway. So it might be that first one feels like it's a little high, but then over time, your other investments, everything else is growing too. And now the next time, a year later, when you do the second one, it may be that if you say, well, I'm going to put 10,000 into 5 things, or I'm making numbers up. I don't know where everyone's net worth situation is, but I'm going to put 100,000 into 5 things. That's easier to place because people will take 100,000. But building it out over a period of time might mean that at first it's more than a 2% total allocation. It might be 3 or 4. But then the next time you do one, you're over time that you're kind of building out a portfolio.
So what I'm hearing is that as a starting strategy is getting started. Getting into a fund is a way to sort of hedge, so to speak, right? And be part of a community, put some of the burden of that decision making and market assessment into the fund manager instead of your hands. That also led me to wonder, does everybody here feel comfortable with the definition of a fund versus going and giving checks yourself? Yeah. Okay, great. If you don't understand any of the language or any terms here, please feel comfortable raising your hand because we want to make sure that every part of the conversation is accessible, because if you're thinking it, somebody else definitely is too.
I'm actually gonna.
Yeah.
I wonder if everyone really does know like how funds work, because I started writing checks directly to companies and I didn't know about funds and I didn't know how that worked. And if I look back in time, I got really lucky. But if I were to do it all over again or advise my daughters, I would have them not do it the way that I did. I had fun and it was interesting and it stroked my ego and I made some money, but I would definitely do a fund before I would go just like randomly picking companies because I like the people. Because you likely will probably not see your money. That's just the way the game works. So I think it might be worth even for like a few minutes to just cover LPs and how it's structured.
Yeah. So I'll speak high level and then fact check me and fill in the details. So when it comes to a fund, this is, we've got many of these venture funds here in the Phoenix ecosystem, for example. If was anybody here in December at the Jane Project event, we had Monsoon Ventures come and give a talk about their fund. So this is a managed fund where you have professional investors who are finding the companies, finding what we call the LPs, the lending partners. That's us. Those are the people who write the smaller checks. And so they're responsible for assessing those teams. They're responsible for evaluating the market. They're responsible for managing the fund. When they have opportunities, and there are funds with smaller opportunities for smaller checks, when you can pool those smaller checks together, you can join and give, for example, a $50,000 contribution to one of these funds. What that does is, yes, it reduces your return because it's a smaller check, but it's an opportunity within the guardrails of a space where people are experienced at this to start playing and learning while you're doing it.
Oh, all right. I'd also add to that they get access to deals that the regular person otherwise wouldn't, which also has an impact on how successful your outcomes could be because they're in the game, you're doing it full time. If you're someone who
has who has a job in a corporation locally, you're like, oh, I always wanted to, I like this company and that company. Kind of like Terry, how you were saying, I know the companies the software companies that we invested in, like it's just sort of you just by chance come across. Cool. And that's like more of a hope as a strategy rather than a real their strategy. So and that's where they earn their percentage.
Yes.
And increase the likelihood.
And that's it. Just understanding how, like, when you're an LP, which I thought limited partner, but lending partner, they kind of feel. I haven't really heard that, but that sounds.
Nope, that was I agree.
Yeah. The GP, the general partner, either puts less in or doesn't put any in, but they're running it, so they kind of get their percent. So if it totals 100%, and there are 10 of you, and the GP usually they do the work and finding everything and overseeing it, and that's how they earn their percentage versus paying in for their percentage.
Oh, we have a question. Top there.
How does the average Jane trying to get into investing evaluate which funds are the most experienced and maybe experienced in a good way as opposed to a bad way?
Sure. I mean, again, it's about the people. So if you look at the people that are running the fund and their backgrounds, and a lot of times the funds are focused, and I don't know Monsoon, but it's like, I'm using healthcare again. If it's healthcare, they're usually healthcare professionals. They've started healthcare businesses. Like they know that the general area, and they will focus in on finding companies that fit that bill, and look into these people. Who are they? And how have they done this before? There's really no other way to have they. And sometimes they've done multiple funds. Like this will be the third fund that they've done, and they have different timelines. So they may have done one 15 years ago, and you can see their track record. Know that the track record means. I don't mean to say it means nothing, but it means that they have experience, not that they are going to produce the same returns. And maybe, frankly, the more they've done it, the more they've learned. Maybe their early ones didn't do well, but they're doing better and better because they're doing a better job of picking. But it is, yeah, you're trusting them.
Is there a central spot or even just on a per firm basis, a place where you can see their wins and losses over time? So you can see from a data perspective.
Typically, if they're soliciting you to join the fund, they'll show you their prior results. But I don't think there is they're not, depends on how big it is. If it has,
I think is giving a lot. Also, Peter Walker with Carta releases a lot of those kinds of data reports. I like to follow him.
Carta is a great, yeah. So,
and Crunchbase. Thank you, Rachel. Yeah. Should we just go right into Q&A now?
Well, I've got one question I wanna while we're defining things. We talk about this a lot at Jane events. Can we talk about the difference between angel investing and venture fund investing? That way we're getting real clear on what some of these earlier stage opportunities are.
Allie, go.
Angel, well, actually, Meg. Oh no, I shouldn't read it.
Meg is both an angel and a venture fund investor. So you want to take it?
I can, yeah. I'll go for it. So angel investing is usually smaller checks earlier on pre-revenue. You're taking a bigger risk, but you have, obviously a bigger surface area for returns if it all works out. Venture, it's usually larger check, bigger investment. It's the funds that we've been talking about. So you're working with a GP, you have other LPs, and that is going to be farther on in the startup's journey. So usually they are post-revenue, not quite ready for expansive growth, but hopefully under the time that they're with your fund, that's what happens. And is there anything else? I think that's maybe the biggest figure.
Thank you. I think the high points would be your money is probably locked up for at least 10 years with a venture fund. You made that point earlier. It's not liquid. Could be the same with angel investing too, but with venture funds, for sure, it's probably going to be right. Aaron's nodding. So yes.
And sometimes longer.
Sometimes longer.
Patient.
Yeah. Patient capital. Yeah, that's a great way to put it. Did that answer the question? Okay.
Now should we jump into Q&A?
Yeah. Questions? They've already started, but comments? Oh, Kathy.
I just wanted to echo what Terry said and just say that
I don't come from the public markets background that Teri does. I come from the, um, I guess I didn't really, our family, me, and I brought my husband along, but I was the one who was like, let's do all these different things. And he's like, okay. Um, we did it backwards. And so we've only recently, in the last many years, gotten into public markets. And if I could go back in time, I would have not done the more reckless investing in the beginning, and I would have done real estate, and I would have done public market, and I would have saved, and put it into that rather than investing in our own businesses and also investing in other people's businesses with direct checks. What's public like stocks, stock market. So whether it's your Roth IRA or it's an active brokerage account, where you're investing in companies like, the Magnificent Seven, like right now, like Nvidia and Meta and whoever else is on that list, Microsoft, or get into funds. So invest in S&P 500, like look at the Vanguard funds and pick up a number of those and invest in those for your 8 to 12% return over time. But I just wanted to validate because I know that this is about people getting into venture investing. But I think it's really not for the faint of heart. And so if you're writing a check for 10 grand to an entrepreneur that you really like, you want to get on their cap table, there's maybe a bit of an ego, like, oh, I want to be able to say I'm an investor and be part of this. And, like that's great. And I did that. And also realize that you likely won't see that money again. And if you happen to get an awesome email, years down the road, like, hey, we just got acquired and your 10 grand is now 20 grand. And it's, oh, great. And then if the founders stay for 2 years, then you get an additional, I don't know, 5 grand. I'm just referencing one of our investments. That's great. We invested in 6 companies and one of them was a big winner. 2 of them, we doubled our money, and then 2 of them went out of business. So like those, what you were saying, Teri, I just want to validate that's not just your experience and you're speaking for the industry, but I think wealth creation is really around managing your risk and identifying the places where you're going to put boring money, patient money, exciting money, adventure. This is going to spice things up, but really level up to that, so that you're really smart about your own wealth creation, wealth building strategy, because there are a lot of options out there, and many of them sound very sexy. And, oh, I want to be doing that. But I think you have to earn your way into that, so you can sleep at night. And
It's not a get rich quick scheme.
yeah, it's not. It's not. And that really seems to be like passive income and all. Like it's like very of the moment. And I think all of that is shenanigans. And really, it's about making smart choices, taking calculated risks, knowing that could all go to shit, but that if you're smart around your diversification, it'll all work out if you're in the game.
And I love that.
Thanks for being here.
I love that language you just used too, because it's so clear, right? Boring money, shit. Patient money, yati. Shenanigan. You may just see that in some Jane project content.
Super quick just to follow that on, and I have to preface with I am not a financial advisor. I'm in insurance, not even like directly in the financial space, so don't take my word for it, but I just want to say how I thought about it, and what you're saying about building into it makes total sense. But first things first, right? You've got to have your debt under control, then you need to have your liquid savings for emergencies, then you're talking about it earlier, making sure your retirement and your brokerage account and those are funded in the way that you want them to. And then you start thinking about angel and venture. Now, if you're like me 5 years ago, that was a long road to cover. And I was very excited about the space and I still wanted to do something. So actually, that's something a little bit unique. And I had a budget line item for community impact, right? So these are organizations I would have donated to or community projects that I would have funded. And it wasn't a lot of money, but I started using that to write small angel checks just to get involved and learn as I was building, like you were talking about, into being able to participate in the venture space. So I think that's a good
I love that. Like, so I have a client who is just like, I'm not interested in doing charity work. I don't want to give checks to charity. Just I'm really not interested in that. I want to give checks to people who are starting businesses. And like that is his charity. It's not deductible. So I think we have to get away from the like charity is about deductibility. Because if you invest in something and it doesn't work out, you do get a tax break, and you don't from your charity stuff. So I hate to, again, I don't like to call it charity, but if you decide your community engagement is going to be through supporting businesses, great. I mean, categorize it however, people say, I'm gonna give 10%. Well, what does give mean? That 10% could mean I'm gonna start building into something. And if it works out great, I'm learning along the way. I love that, learning along the way. And if it turns into something great, but I'm learning along the way, and that is my give. And so just framing it like that, I think when you don't have all the things built up yet, that is a nice way to look at how you're gonna budget for learning into the space.
So I have a question talking about angel investing versus fund investing. Do you see, I mean, with angel investing, you get to keep 100% of what you return on that versus a fund where you lose a little bit of that carried interest and you have to pay fees. Do you see that as an impediment to somebody starting out investing?
I don't have angel experience, so I can't even speak to that. But that's the difference in the next level is they already have some revenue. I mean, there's already something there. I can't. I'm not
Well,
qualified there.
Yeah, I think what Aaron's asking about is are the venture fund, the fees that you pay to the venture fund managers,
Is it
inhibitor.
worth it? Yeah.
Yeah, and there's a lot of philosophy about that, isn't there? Like, in the one case, if you're an angel investor, you're owning the due diligence process and doing your own research, and so you're avoiding the fees and the 20% typical carry. But on the other hand, you're putting a lot of work on your own plate, I would say. So when you're looking at angel versus fund investing, you're looking at, am I handing this check over to an expert who's going to do all the work that I don't have the time to do or don't want to do or the expertise to do? And in exchange for doing that, yes, I'm willing to pay a 2% management fee so they could do this. And they get a piece of the action at the end of it versus, okay, I'm going to invest in 5 companies, as Terry recommended. I'm going to have a diverse portfolio, but I have to manage that portfolio, and that takes a lot of work.
Like, I don't have time for that.
Yeah.
And I live in this space, so like and one of the reasons that I don't show up at the Golden Seeds meetings because I don't feel like I have anything to. I can't dig into a balance sheet, and I also work in a space where if I say I want to do this and people follow it, I'm liable. So there's like I'm in a funny space here where I have some like even if I told you all like, hey, I'm going to do this thing, I didn't recommend it to you, but it could be taken as a recommendation. So my world is very, very regulated, and I have to be super careful.
A Jane Project is a non-fiduciary education community. That's my disclaimer.
I think one of the things too to think about if you're going to venture into a venture fund is to look at the fees and the structure of the fund because they all vary. There's very different types of funds you can put money in, and then there's commitments over time. And then there's also singular funds that maybe say this is only the one time. And then the fees will differ as well too. So you have to look at sort of what you're willing to give up and what the benefits you're going to get. And I think because every fund is slightly different.
It's like hiring any expert to help you with something, right? It's how much of that burden are you going to take on yourself versus how much are you willing to pay to put that burden on somebody who's got that experience.
All right. Thank you for speaking. You were talking about a client you had in Seattle, and you said you would invest in it, but you couldn't but you love the people that he attracted, right? So I just want to zero in on like what specifically is about the people. What are the values in the people that you invest in or made that attractive? Just can you talk about the values in those people?
And this guy's not looking for funders because he has his own money. Right. But it's interesting to me because when, how do you decide? I'm always impressed when you see some, and this isn't venture, this is more like, maybe they've gotten to a certain point. Now they're looking to really take it to the next level, like a different fundraise level. But I like in this particular scenario, I mean, the fact.
You in general, like the value.
Yeah, sure. It's really kind of about the experience that they're all bringing in, and how it's also how well is the founder able tell the story. And storytelling is a big part of how we all decide to buy in, and if you have someone who can't tell the story, they're not going to get the money. I know, like it's a sales pitch thing, I realize, but and then what's like this guy, his background in this other company was like, it's amazing. I trust him already. And now the people that have left big careers to come be a part of this and get an ownership stake, and I've seen their cap table and cap tables, everyone know what a cap table is? Giving nods, okay. So it's capitalization table. It's basically the Excel spreadsheet or Carta once you get there. That lists like the founder has 82% and the next person has 12%. It's like the ownership table of who owns what. But seeing people leave big cool things to come do this other cool thing is like, it just speaks volumes. And that again, that's not always the case. Sometimes the presentation will talk about, I'm looking for these 3 roles. I'm trying to fund, like maybe the reason they're raising money is because they need a marketing person and a salesperson. They need 3 salespeople or whatever. That is what you're funding. So it's hard because sometimes you're funding before you see the people come in. So you have to kind of like go along in the journey a little ways, or sometimes people will come in and part of how they get paid is ownership. That's a big deal. You're willing to take a role at a reduced salary with an ownership stake in a private company. You're making a big commitment there that you're in. So just seeing how the people have bought in, I think that's not just the founder, but how others have bought in feels compelling. Yes.
Okay.
Go ahead. Thanks.
Right. It's spot rolls. I took the microphone because I have a question in the mouth.
Oh,
But
you with Boreal. All right, so let me just answer to your thought there, Malcolm. Yes, being on the pitch side of the money, they're looking for people that do.
Yes.
They're looking for people that execute. They're looking for people that get shit done. They're gonna do smoke together. Yeah, it's a great investment if you're jumping from Microsoft to jump onto this new gig. That's great, but it could just be somebody drinking the Kool-Aid. Investors are looking for you to move the dial. Do what you say you're going to do it ahead of schedule, and do it well. That's what they're going to buy. Sir. Ellen?
So I've been on both sides of this conversation. Angel money coming into my company, and angel investors can be a pain in the neck. And that's giving them 2 feet. Okay. I've been in some general partnerships, and not getting the information from the general partner. So and the second part, in seeking venture capital, we were willing to put that person on the board and have the controls that they were insisting on. So we walked away from venture capital, and going public was the star in our eye, which we didn't do. In a fund, how close is the general partner to the company that is being invested in? And how much will they tell you when you ask questions? In my experience has been not enough. But they're getting financials. That's part of the deal of getting the money. They may be on the board, but they should be getting board level information. Is that what you can expect in a general fund like we've been talking about?
I'm going to defer that question to like an alley. I feel like I'm in another thing in another project that I expected quarterly somethings, and it's like annual, and I forget about it. Like I forgot about like just now. I'm like, oh yeah, there's that other one that I never hear about. I think it's like, what's the agreement? What did you agree to? Did they say in their pitch book that they were going to provide quarterlies a lot? Things move fast, and I would say that's probably too often. I'm used to that in the public markets, so I'm used to quarterly. So my brain was thinking that, but an annual, sometimes
So I think the question is, around how often should you expect the GEP to communicate with you as a limited partner in a fund? Does that sound right?
And the level of detail.
And the level of detail.
Yeah.
Aaron, can I ask you to answer this question? Okay. I feel like it's your expectations should be low.
And that's been my experience. Yeah, that's not what I want.
I know. I hear you.
Yeah, so it can depend on different funds. So I work for a fund that invests in VC funds, and it can go from quarterly to annually. The level of detail is we get a breakdown per company they've invested in, and some of the high level details, milestones, that kind of stuff. And then we see overall fund performance. If there's been any changes in if there's been a liquidity event, or if there's changes in valuation that impact our investment.
Because valuations never happen more than once a year, and some don't even do that. It depends. Like if they allowed IRA money, they have to do an annual. So some early stage won't allow retirement money because they don't want to do an annual valuation, because valuations are expensive. Like, do you really need that?
We ask for valuation updates once a year, and then we also mandate quarterly updates. So our funds give that to us, but it's not standard.
I can add, I do some work for an emerging venture fund that's a small first fund. And they give quarterly updates to their LPs. They have a quarterly meeting, but at any time an LP wants information, they can just call the general partner and ask. So that's one of the benefits of emerging funds versus bigger legacy funds. If you invest in a Andreessen or I'm blanking on names right now, you're not going to have that level of connectivity to the general partners that you would with an emerging fund.
But I think the quarterly bullets, that's kind of what most people are looking for. I wish that more of companies would do it, but just give me 3 high level. What's happened since last time? Where are we? I mean, because otherwise you just go off and you flutter into space if there's no one asking for the data. That's a benefit too of having a GP, of having a fund and having a general partner, is they're pulling that data for you. Sometimes you blink and 6 months went by and I don't think I heard anything. Did I hear something? I don't remember. Just having someone who could keep it together for you.
We are right at time, but if anyone else has any questions yes, Rachel.
Well, the question they had fair and offers. Oh, sure, education. That's helpful. Yes. Keep it. Hi everyone. Just adding to all of the great points that have been made. When you're distinguishing between VC and angel, the biggest difference is stage and access. So there is some overlap between VC and angel investing, typically around seed stage. But other than that, VC investing is if you want to invest in later stage businesses that already have proven track records of revenue generation, because generally angel investing is not available to not available to angels once the company has reached a later stage. So if you want to de-risk by investing in still high growth, but later stage companies, meaning let's say they've got 2 million and above in annual recurring revenue already, they can give you metrics on year-over-year growth, gross margin, profitability, future profitability, structure, business. Then you would want to err more on the side of a fund because you may not have access to those companies as a direct angel investor. Whereas if you are willing to take a higher risk, then angel investing, even if it's through a group like Golden Seeds, that's where you'll be able to invest in the earlier stage investments. Another lens to think about is the percent of ownership, both for the VC fund that you're investing in. What percent of ownership do they typically take in companies they're investing in? What percent of ownership do you want to have in that fund? Versus what percent of ownership do you want to have directly in a company, in each company that you're investing in across your portfolio. So if you stratify those two lenses, then you can get a good sense of how you want to diversify your investments across angel or VC, whether that's through an angel group, direct angel investing, or venture capital. So I hope that's helpful, and that will also influence how frequently you're going to hear from the company. It all boils down to what percent of ownership have you taken in that company.
Space.
I had a question for you, and I'll lead into that. I too have been involved in startups where my brother and I had like $5,000 in the bank, and we moonlit, and we later sold the business for 64 million. But it was a tech company, so we had mass growth, but we had choices along the way of taking an investment. And initially, angel investors, well, it's usually friends and family, are right there near you, and you're stressing because you don't know if you have a product market fit yet. You don't know if you have a proven model until you get to a certain stage. And then when you get to that stage, you're like, okay, we can look at angel. But for that point, the angel doesn't see that you have that income yet. So you might have prospectus, you might have a proven market fit, you might have people paying for like a 12-month membership. And then when they're paying for 12-month membership, they're telling you, I want your product for 12 months. They're not just saying, I want to try it out, you know? So once you have that guarantee and you have that money coming in, that's a good time for angel because you've proven the product market. The angels can come in and have some interest and some equity. They can earn sweat equity. They become people equity because they're part of your organization, but they have to be the right fit. But we were told we couldn't even access venture until we made the $5 million mark. So I didn't know if that was still a number.
It's generally so sorry. Yeah. So generally venture capital funds now do span a greater um variability of stages than they used to. So you can find early stage, typically they're called micro VCs, that write smaller checks into earlier stage companies, but they're still looking for repeatability and early revenue. So that would be the earliest a venture capital firm would invest. And that's at what's called it's still considered pre seed, but you have to have some revenue, a built product, you're in market, right? Um, and then that's the earliest, but the sweet spot for venture capital and when they really typically start leaning in is around 2 million in annual recurring revenue. And that's at what maybe you call a late seed or early A, um, Series A. And so the bulk of venture capital is Series A and Series B. And then those are generally 10 million in revenue is Series B, and 2 million in revenue to 3 million in revenue is Series A.
Terry, I have a question real quick, and I'll pass a recap. What advice would you have for a woman who wants to be a venture fund investor someday or an angel investor? They're not quite there yet with their safety net. How do we get there? How do we start planning ahead for that?
I don't have that answer. I mean, I really liked the investing in the community. Like if you take a percentage and you just say, I mean, I go back to like what Kathy said. If you don't have your baseline of cash and you don't have the start of your there's some baselines here that I don't think you should do it until you get to a certain place of comfort and knowing that everything is taken care of. However, you can come to groups like this and learn, come to the talks and learn, get in it so that, and put some numbers, put some goals to it. Well, when I get to here, and whatever that means for you, and it's different for everybody, when I get to here, I'm gonna kind of set aside and I'm gonna start doing this. And again, I think if it feels community based to you and you want to make it kind of your community give, then that's a difference. Like you can bucket it a little bit, but if you're doing this because this is an investment strategy, you really have to get your ducks in a row first. before you feel like it's time. And I know that is like so big.
Well, I think there's something interesting there too that comes to mind when you say that is that each one of these is a building block, right? And I have
Knowledge too.
yes, right, and experience that we're building as we are exploring and learning. Do each of these layers have a relationship? Can you leverage them to get to that next layer, right? Or so, for example, if you're in the public markets, do you say, if I make this much on the public market, I'm going to squirrel away a percentage and start kind of like a rainy day fund for your future PC?
Yeah. Yes, I like that.
I was like, it's the same thing.
And just make it a piece of the pie.
Question I want to take us home. Yeah.
Well, I think first of all, I love the baby in the back just watching his mommy as she's talking. The best. That's just the best.
And that voice, like on speaker.
Like, yes, as were we. He was mesmerized by you speaking. But I think one of the things I would say to this is find ways in your life on how you can increase your income, whether that's a side hustle, whether that's your existing job, and strategizing and framing yourself in a way where you can make more come the next performance review, or how you can tap into a greater portion of the bonus. Or if you have your own business, how you can fire some clients and get clients that are better paying, and what that looks like. Because it's really about increasing your income. If you don't have the income, then, I don't know how that's going to work for you, but it's going to take you a lot longer. And then once you're motivated to find ways to increase your income in creative ways, that's when you can look at this, okay, I can do some new things in my financial portfolio. For research, I wanted to mention there is a resource locally called Freeway. For anyone who's not familiar, you can see what's the funding activity happening here locally. Who are the funds that are in Arizona if you have an Arizona specific thesis? Who are the venture funds? There's a lot of information. It's freeway.vc. Yeah, I don't know what the website is.
Freewayphoenix.com.
Yeah, that's it. Thank you.
It's a wonderful dashboard, and it's for us. It's for our community. It was established in order to take this data and put it in our hands so we can do something exciting with it.
So I just wanted to promote Freeway. Yeah. Thank you so much. This is a great topic, really important information.
Thank you. Thank you.
Thank you, Teri. We're a little over time. Is that okay?
All right, one little plug as you guys are heading out today. Of course, technology is technology. As you're heading out, don't forget that if you have not subscribed to our email marketing, followed us on socials, or checked us out online, go ahead and do that. You can find us at that QR code. And stay tuned for a very exciting lineup of fall events. So you will be hearing from us pretty shortly with what's next with the J Project.